Let's start with this. If Macy's buys too much stuff and now they have too much inventory, or if a store is on the verge of going bankrupt, these stores might have a liquidation sale where now they're going to sell their stuff at a discounted price, and you're going to see commercials and advertisements for these new discounts that they have for purses and sweaters and all that stuff. When that happens, you see a line around the block of people trying to snag a purse or a sweater at a discounted price because everybody wants to get the sale. Well, when you're buying this stuff from Macy's or whatever store, you are buying a liability. You are making money for Macy's or the store, but you're just buying something for you. What happens here when you have a recession or a market slowdown is the asset, the business, or the thing that makes money goes on sale. And this creates an opportunity for you now, the investor, to buy a piece of the production, the business, the real estate, the investment at a discounted price. And this is where you need to know what to look for and how to find the opportunity. The nice thing about shopping for assets on discount as opposed to shopping for liabilities on discount is when you go to Macy's when everything's on sale, you have everybody there trying to buy the same stuff. You might have to fight somebody to get that sweater or to get a TV. But when we're talking about buying assets, there's no lines. You're not competing against everybody, and now you have so much opportunity around you if you know where to look. So the question then becomes, where do you look? And the answer to that is going to depend on how involved you want to be. Booms and busts are a part of our economic system. They've been happening for centuries, and they will continue to happen. And what happens to so many people is they don't expect it, and so they get blindsided by it, and then they lose everything. But the people who understand it, the people who are financially educated, are not shocked by it. They just know what to do when it happens. So what happens typically is you see these types of booms and busts. Overall, the market is growing, but you have these boom periods, and then you have these bust periods. So this is when you have a market crash, you have a recession, you have bad things happening, people get scared, they panic, they sell off, and this creates a huge opportunity for you to now come in, buy, and ride the wave upward. Now, the goal for you isn't to perfectly time the market, because nobody can perfectly time the market. Nobody knows what's going to happen tomorrow. Nobody knows when a pandemic is going to shut down the economy. You can't predict these things, but when you see these types of drops happen, it creates opportunities for you to come in and buy when they happen if you're financially educated and if you're prepared. When I say prepared, that means now you have access to cash, you have access to capital to go out and actually make an investment. Now, what does that mean? That means now you have to start putting aside cash. You need to start earning more money. That way you have a margin, you have money, you have capital to actually go out and take advantage of opportunities that come your way. Financially educated means knowing where to look, knowing what type of opportunities you want, and how involved that you want to be. Now, I'm not going to go over all the different factors that are leading to the economic slowdown that we're facing today in this video. I have other videos on my channel where I've already gone over that. If you want to watch that, I will link something for you down in the description. But in this video, let's start by talking about the least involved way for you to take advantage of this coming economic slowdown. This is for some people now who don't want to spend a ton of time or energy or effort or even risk trying to figure out how to invest their money. Number one, the most passive way for you to take advantage of an economic slowdown and a market crash is by doing something called DCA, which stands for dollar cost averaging. What this is now you have a system set up where every single week, ideally, or every other week, every time you get paid, now your money is going to automatically leave your checking account, and it's going to be automatically, passively, consistently invested into a number of different stocks or ETFs or potentially even cryptocurrencies, depending on what it is that you want to invest in. I'll talk about the different opportunities you have, but it's going to automatically be invested. Now, the nice thing here when you have an economic slowdown isn't just that you potentially could have more dollars to invest. It's that when you invest a dollar, that dollar is going to stretch even further. To give you an example, if you wanted to buy a stock that's worth $100 and every single month you're investing $100 into this company, well, that means every month you're getting one share. But if you can keep investing this $100 a month, and let's just say the price of the stock drops to $50, well, now you invest $100 and you're getting 2 shares for the same price as before. I have a dollar cost average system set up, but I don't dollar cost average into individual stocks. Instead, I dollar cost average into ETFs, which are funds that give me exposure to a whole lot of stocks. Because now when I do this dollar cost average system, I'm not at dollar cost averaging for 6 months or 6 years. I'm dollar cost averaging forever. And so I don't want to have to worry or research the companies. I don't want to have to think about what companies I'm investing in. Instead, I invest into a fund that gives me exposure into a lot of different companies. That way I can keep dollar cost averaging essentially forever. That way I don't have to worry about it. I don't have to think about it. It just happens consistently, passively, and automatically, because this is my most passive, my least thought about investment. And this will continue to happen whether the market is up or whether the market is down. This is a long-term investing strategy that you don't want to have to be thinking about what you're doing. You just set it up and let it happen forever. One example of this, now I can't tell you what to invest in because everybody's financial goals are different, your risk tolerance is different, your time horizon is different. Just giving you some examples to research. One example would be investing into an S&P 500 ETF. The S&P 500 is a group of the 500 biggest companies on the stock market. So it's essentially a way for you to invest in the American economy. Two ETFs that give you exposure to this are VOO and SPY. I personally have some of my own money invested into VOO as a disclaimer, but these two ETFs do essentially the same thing, where now you're getting exposure to these 500 companies. If you want to take on more risk, then you can consider investing your money into ETFs to give you exposure to technology and innovation. This could be ETFs like QQQ and ARKK. I do have money into the ARK funds, but QQQ now gives you exposure to things like the NASDAQ, which is primarily composed of tech companies. ARKK is another ETF that invests in now innovative companies, tech companies. These types of companies are going to get hit especially hard because there's been a lot of cheap and free money floating around for the last decade, and they've already been hit very hard. But the companies that survive could also have the opportunity to thrive after, so it can create opportunity. Is it more risky? Yes, absolutely. Because many of these companies rely on cheap money. They rely on cheap capital. They rely on investment dollars in order to grow quickly. And our economy and our economic market is changing, which could negatively impact these types of companies, but more potential risk, more potential upside. And this is where you got to understand where it is that you want to be investing and how risky you want to be. What if you're looking for some passive income, some cash flow where you can get paid without having to sell your investment? Then you can look at investing your money into dividend-paying ETFs or high dividend-paying ETFs. A couple examples of this would be VYM and SCHD. I have my own money invested into these funds as a disclaimer. But now what you're doing by investing in these ETFs is you're investing your money into companies that are working to pay dividends. And this is where you got to understand what your goal is, because now when a company is paying out a dividend, that means they're taking their profits and instead of reinvesting the money back into the company, instead of reinvesting this money into their savings, they're taking this cash and giving it away to shareholders. And so you're not going to see as much growth here that's potentially here, because most of these tech companies are not focused on paying out dividends. They're focused on reinvesting all their profits and some with the help of debt, with the help of other investment dollars. That way these companies can grow as quick as possible, as fast as possible, the highest risk, versus these companies are just working for that slow and steady growth. And then when you go through an economic slowdown and companies see that profits get cut and people then start cutting their dividends, that also hurts these companies, especially because now when the investors are investing in these high dividend paying companies for their dividend and then their dividend gets cut, now many investors are more likely to sell the stock because they're not getting that cash flow. But that can also create more opportunity here if you're investing your money into these dividend funds, because then once the economy recovers and these companies start recovering their profits, then they might and hopefully will start repaying their dividends, which would then make it a more attractive investment for investors again. So not only do you get to buy in when dividends are cheap, but hopefully you'll also see the price of your investment rise. Now, does it always work out like this? No, but this is where you're hoping and investing your money into the places where you can see the most potential upside based off of what your goals are. And then you could also consider dollar cost averaging, investing your money into emerging market ETFs. These are now companies that are outside of the United States that don't operate based off of the dollar. So now when you're worried about a recession, you're worried about an economic slowdown, you're worried about inflation hurting the dollar, well, one thing that you could potentially do is invest your money outside of the United States into countries and companies that are less affected by what's happening within the United States. A couple ETFs that can give you exposure to this are VWO and SCHE. I have my own money invested into these funds as well, but now again, higher risk, but more potential return, because now you're investing in companies and countries that are not heavy in the United States exposure. These are companies that are growing in other countries like Brazil and China and Taiwan and Japan and Korea. And so now when you're investing in this, you're trying to get exposure elsewhere, but it has more risk because many times these countries and economies aren't as stable as the United States. They're operating with a currency that isn't as stable as the dollar, but more potential upside. And so now this is where you got to understand where it is that you want to be investing, what kind of exposure that you want, and how much money can you now invest every single week. This is a way for you to build wealth, not just through a recession, but over your lifetime. However, when you have market slowdowns, when you're dollar cost averaging, the dollars that you're investing through your dollar cost averaging can buy you more shares, can buy you bigger quantities of things because the prices of things are going down, and every dollar that you can invest will stretch further because you're seeing this essentially deflation in the asset markets, in the stock market. So it gives you the opportunity to buy more for each dollar that you invest. And so when you go through these types of market slowdowns, you want to be dollar cost averaging even more aggressively. And the nice thing is you don't have to worry about trying to time the market here, because now when you have a dollar cost average system set up, where now you're buying, say, every week, well, now you just keep buying whether the market's going up or down, and you're going to see these wild swings upwards and downwards and upwards and downwards, and you don't have to worry about it. Because every time it comes to your day, for me it's every Wednesday, it does not matter what day you pick. Whenever your investment day comes, you'll be able to purchase more shares of your investments. Now at the time of me recording this video, I use a platform called M1 Finance. They are an affiliate of Minority Mindset. If you want to learn more about how to use them, I got the link for them down in the description. There are many different brokerages that allow you to do this type of dollar cost averaging. Do your own research. I like M1 just because it's super simple to use, but you can do your own research. If you enjoyed this short clip from my longer videos, here's another clip that I think you'll love. And while you're at it, if you're interested in learning more about how to start generating passive income, our team put together an amazing guide on how to start generating passive income for free. All you gotta do is click that button right over there. Thank you for watching, and as always, keep hustling.